Well, today we're talking about something that can make or break your retirement. That's long-term tax strategies for retirement. And trust me, this isn't just about paying taxes. It's about keeping more of what you work so hard. If you think about those folks that are getting ready or moving into retirement time, probably one of the biggest debts that they have is the amount of taxes that they owe on their traditional tax deferred retirement account. And I think here's a myth. And the myth is society taught you to save and invest in traditional tax deferred retirement accounts like 401ks and IRAs. And the reality is that the conventional wisdom said that tax rates will be lower when you retire. For an overwhelming majority of retirees that we've worked with over the past 30 years, when people retire, they have more free time to go out and enjoy the fruits of their labor, right? So they're taking the travel, they're doing those home renovation projects that they wanted to do, they're spending time with their grandkids, they're enjoying life. And oftentimes, what we see is retirees, their tax rates is not lower in retirement time. Add on top of that the fact that you can end up paying, Social Security tax. If your income gets too high, you can pay more in healthcare expenses. You can pay more in your Medicare premium. So taxes can really chomp away at retirement time. In fact, that's why we've done a couple of these tax seminars here recently, and both of our events that were sold out, we have had to go ahead and add another event that we have coming up in November, where we're going to be doing another tax event. We're going to be talking about how to avoid voluntary taxation and how to keep the government away from your money. If you want to find out about, making a reservation for that tax event, just go online to arhq.com. Click on the events tab and register for that. Maybe you're watching us on YouTube or listen to us on a podcast and coming to our local event doesn't work for you. We also offer virtual tax what-if analysis, and can help show you some of the retirement tax traps that can drain your retirement savings. If you go to retirementtaxpartners.com, you can click on the tax what-if, and ultimately we can take a look at that, because taxes really matter in retirement time. When you're working, taxes for most people are pretty straightforward, right? You earn money, you pay taxes, you move on. But once you retire, your income sources can change. You've got Social Security, you've got pensions, you've got investment income. Do you take money from your 401k or your savings first? Do you pay off your mortgage? What do you do? Your tax picture is different. You've got money coming from all of these different sources, even if you're working part-time. And each of these sources can have different rules that apply to their situation. And if you're not careful, Uncle Sam can end up being one of your biggest expenses in retirement time. And that's really why, you got to look at your money into the three different buckets. You've got to look at buckets of taxable money, your bucket of tax deferred money, and your bucket of tax-free money. And the approach and what we take a look at is that the overwhelming majority of folks, they have done a great job saving and accumulating money into the tax-deferred category, but they oftentimes stop there and they don't get money over as much into the tax-free category. For decades, again, the 401k or the traditional IRA was the go-to retirement savings tool. You got the deduction up front. It kind of felt great. But remember that every dollar that you have coming out of that traditional tax deferred retirement account is going to be taxable income later. It could create taxes on your Social Security, healthcare. You could get to a point where you're forced to take required minimum distributions, and that income could put you into a higher tax bracket. It could increase the premiums that you have to pay for Medicare. It can cause excess taxation on Social Security. So, one of the long-term strategies is looking to start to convert some of that money from tax deferred over into the tax-free category. And the way that you could look at doing that is you could look at developing more money into the tax-free bucket. A Roth IRA is just one example of that. Roth IRAs, Roth 401ks are powerful tools because it gives you the ability to have potential tax-free growth and tax-free withdrawals in retirement time, and the ability to transfer wealth to the next generation and provide them some of the tax-free benefits as well. Here's the key though. When you think about this, it's not an all or none scenario. Meaning, if you're saving money in a 401k, it doesn't mean that you had to switch all of your money to the Roth 401k. Maybe you should switch half. Maybe you should switch part of it. Doing something, though, is going to allow you to have different buckets of money that you can pull from. And that way, no matter what the tax code is in the future, you've got a little bit more flexibility. If you have most or all of your money in the tax deferred category, you're always going to be subject to what the government decides is their fair share on what they're going to tax you. The same would be true as if you're looking at conversions. Right now, we're very active in doing these tax what-if analysis and helping figure out, the big, beautiful bill that went into effect in July. What does that mean for tax planning opportunities? And you need to run the tax what-if analysis before the end of the year. In fact, I would say do it as soon as possible because the end of the year is here. The problem is a lot of Americans are going to wait until, say, collecting their tax documents in February or March to get their taxes prepared to see what the big, beautiful bill meant tax-wise. And the problem with doing that is many of these tax strategies are no longer available after December 31st. So if you want to look at, trying to do conversions and doing some partial conversions while you're in a lower tax bracket, you need to do that before end of the year, which is why running that tax what-if analysis makes a big impact as well. We're going to do another segment. I've done a past segment on this, and this segment is also talking about what's called the widower's trap as well. And what I mean by that is, we spend a lot of time, we look at our taxes as a married couple, right? So we can run a tax what-if analysis and we could say, hey, as a married couple, here's what your tax rates look like. Here's what they look like last year. We can say, hey, here's what your taxes look like in 2025 under the big, beautiful bill. And you can look at kind of a side-by-side comparison. But the next thing I want you to do is I want you to think about, what happens if one of the two of you in a married couple situation passes away? What do taxes look like then? Because taxes can be quite a bit different when one of the spouses passes away. And because it's been my experience that when one of the spouses passes away, the income needs don't get cut in half, right? Maybe you have one car versus two, but your lifestyle, you're pretty well established. So as a single individual, you've got different tax rates for what your tax brackets are, Social Security taxation, again, healthcare premiums. Run the analysis to say, hey, what would things look like if, heaven forbid, one of the two of us passes away? That can reinforce the decision while you're a married couple to make proactive decisions now to protect that surviving spouse. In addition to that, making decisions tax-wise can help out if you have a desire and you think that you're going to be able to pass on a legacy to your loved ones. So if you're in a situation where you say, hey, Nolan, I think we've saved enough, we're in good shape, the odds are likely that we're going to pass money on to the next generation, that tax coordination can make a lot of sense as well. Next, what I want you to do is I want you to coordinate your income sources, and I want you to think about smart withdrawals. Here's where the strategy comes in, and that's how you withdraw your money. So again, you might have money in taxable accounts, tax deferred and tax free, and taking money from the wrong accounts can trigger unnecessary taxes. A well-designed plan can coordinate that. We had somebody who had recently come to our event. She came in, and so the moving parts that we were looking at is not only looking at how much she could convert over to a potentially tax-free Roth IRA and stay within the tax bracket, we also had to look at, what income level does she need to have to fall under keeping her Medicare premium too high? We had to look at the analysis as far as what is her tax bracket versus when she leaves money over to her daughter, what her daughter's tax bracket would be with having forced inherited IRA distributions. And then we had to look at, how our required minimum distribution is going to impact. So there's a lot of these moving parts, and that's why you want to have a coordinated plan where your financial professional is working with your tax professional to figure out, what are the accounts that you should pull from first, how much you should pull from each account. Do you take from the taxable? Do you take more from tax deferred? Where do you take and when do you spend the tax-free accounts? And it's not a one-size-fits-all solution. It really depends upon the sequence of withdrawals based upon where you're at on developing a tax roadmap every year. If you are the type of person that likes to do charitable giving, Again, remember that if you're over 70 and a half, there's a strategy to consider called qualified charitable distributions from your IRA. This can make it where your distributions go directly from your IRA to your charity. They can count towards your required minimum distributions. And the best part is they're not considered part of your taxable income. So, if you have larger gifts that you're considering, there can be things like charitable remainder trust, donor advised funds that can help reduce some of the tax liability and create a bigger legacy in the future. Then the last thing I want you to think about is I want you to think about the tax horizon and what's in the future, right? So the big beautiful bill, there's some big changes that impact those people, specifically age 65 and older. But you have to think about what's going to happen after the current administration. And some of the law changes that went into effect are only for the next couple of years. And the reality is we're $37 plus trillion in national debt. So during the course of your lifetime, tax rates could be a lot higher than where they're at today. The window to take advantage of lower tax brackets, and if we look at things right now, tax brackets have historically been a lot higher than they are right now. And, as a self-employed individual, I have to write that check out and send a check into the IRS on a quarterly basis. So I get it. I understand, and I feel that pain of taxes. But what I'm thinking about is over the next 10, 20, 30 years, the course of your retirement, how do you guard your wealth and how do you keep the government away from your money? And looking at your situation, one of the best ways to do that is every year run a tax roadmap, run a tax what if. Those retirement tax traps could drain your savings. If you're working with, a CPA, you're working with a tax professional, and all they do is they prepare your taxes, file them, and put them away, you deserve that second conversation. And that second conversation is where, our tax team at Retirement Tax Partners can help run that tax what if analysis to figure out, are there ways that you can try to minimize the amount of taxes that you pay this year, in the future, and during the course of your lifetime, and if any money's left over, on how to pass it to your legacy. Again, take advantage of that tax what if analysis, or if you're local and you'd like to register for our upcoming tax savings event, you can do that online at arhq.com, and we'd be happy to get you signed up.